Hey everyone, and welcome. Today, we are breaking down some huge changes to Papua New Guinea's tax system. Now, if you do any business with PNG, or you're even just thinking about it, you are definitely going to want to stick around. The country has a brand new Income Tax Act, and trust me, it's changing the game for how international income gets taxed. So, let's dive right in.
So the big question is, are you ready for this? Because these changes, they're going to touch everything, from how you write up your contracts to the way you actually get paid. Let's break down exactly what you need to be aware of.
Okay, first things first. Let's zoom out and look at the big picture. Why do these kinds of laws even come about? Well, it really boils down to a core principle of international tax.
This slide nails the core idea. Every single country, and that includes Papua New Guinea, wants to make sure that if real economic value is being created inside its borders, it gets a piece of that action through taxes. PNG's new law is all about building a modern system to do just that, one that's designed for today's global, digital, and service-driven world.
All right, now let's get right to the heart of this new legislation. It all spins around one single concept, PNG Source. And if you can get your head around this, everything else will start to click into place. So what is it? Think of PNG Source Income as the front door. If your income is considered to have a PNG source, then Papua New Guinea gets the right to tax it even if your company is sitting halfway across the world. The law basically casts a really wide net looking for any kind of genuine economic connection to the country.
And as you can see right here, the tax authorities are going to look at a whole range of factors to find that connection. Were your services actually performed in PNG? Is the building or equipment you're leasing located there? Is the person paying you a resident of PNG? If you're answering yes to questions like these, then chances are you're generating PNG-sourced income.
Okay, so let's say you've figured out that you do have PNG source income. At that point, the law presents you with a critical fork in the road. Your tax situation is about to go down one of two very different paths.
And this is it. This is the million-dollar question. Or maybe we should call it the 30% tax rate question. Do you have what's known as a permanent establishment, or PE, in Papua New Guinea? The answer to this question determines exactly how you're going to be taxed.
This slide lays out the difference perfectly. Having a PE means you've got a significant presence on the ground. We're talking an office, a factory, or maybe a construction project that lasts more than 90 days. The best analogy is setting up a physical shop. Now, if you don't have that, you're more like an online store shipping goods from your home country. But look at the bottom line here, because this is what matters. A PE means you get taxed on your net profits. No PE, and you're taxed on your gross payments. Huge difference.
So let's walk down that first path. What happens if your business activities are big enough to create a permanent establishment?
The answer is pretty straightforward. Your PNG source profits, so that's your revenue minus your allowable expenses, are going to be taxed at PNG's standard corporate tax rate of 30%. This means you'll have to register your business locally and file a proper tax return, pretty much like any domestic company would.
And hold on, because there's one more layer. After you've paid that 30% tax, if you then want to send the leftover profits back to your home country, they could get dinged with an additional 15% branch profits tax. So yeah, it's a multi-layered process for sure.
All right, now let's back up and take that other path. What if you've got PNG source income, but you don't have a permanent establishment? This is where a totally different system kicks in.
This is called non-resident tax, or what most people just call withholding tax. Here's how it works. Say you send a PNG client an invoice for $100. They will withhold the tax, let's say it's 15%, and pay that $15 directly to the government. You only get the remaining $85. The key is you're taxed on the whole payment, not just your profit margin.
A common rate you'll see is 15%. Now, you might hear that and think, hey, 15% sounds way better than 30%, but not so fast. Remember, that 15% is on your gross revenue. For some businesses, especially those with high costs, a 15% tax on everything you bill could actually be a much bigger tax hit than a 30% tax on your final profit. This is a really fundamental difference in how your business is affected.
And the new law gives us this handy consolidated schedule of all the rates. As you can see, different kinds of income get different treatment. Dividends and interest are sitting at 15%. Royalties, well, they have a range, which probably depends on what kind of intellectual property we're talking about. And look, management and technical fees now have a clear 15% rate, which actually simplifies things from the old confusing system.
Now, this is absolutely critical.
One of the biggest updates in this new law is how it defines these types of income. Take royalties, for instance. The definition has been stretched way out to include payments for things like software, digital content, and even leasing equipment. This is basically PNG's way of updating its tax rulebook for the 21st century economy.
Okay, so we've gone through the theory, we've covered the two paths, we've looked at the tax rates. Now for the most important part of all. What does this actually mean for you? What should you be doing right now?
Here is your 3-step action plan. Number 1, pull out every single one of your contracts with PNG clients and look at them again through the lens of these new source rules. Number 2, get really serious about assessing your PE risk. Are your projects creeping past that 90-day mark? Does your agent in PNG have the power to sign deals on your behalf? And number 3, make sure you understand those new, broader definitions, especially for things like royalties. What wasn't taxable last year might be taxable next year.
And there is a deadline. While some transitional rules are in place, this whole new system kicks in for real for all new activities starting January 1st, 2026. So you have a little bit of time, but you really want to get your strategy sorted out now.
Look, this isn't just about filling out forms correctly. This is a strategic issue. These new rules could change your pricing, your business structure, and ultimately your bottom line. So the question I want to leave you with is this. Is your business truly ready for PNG's new tax landscape?